What's up, guys? Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers. So please be careful. Don't get yourself scammed. If you want up to 12 free stocks, Webull is going to give you up to 12 free stocks. When you open a new Webull brokerage account, put at least 1 penny in that account. They're going to give you up to 12 free stocks for just trying out their brokerage app. There's a link down in the description box of the video. Go click on that Webull link. Open up your new brokerage account today. Go get that free stock. Go get that free money. The Fed's main job is to balance risks. If interest rates are too high, it could cause customers to stop spending. And when customers stop spending, businesses stop hiring. Our unemployment rate goes up, and that could cause a recession. If they keep interest rates too low, customers might spend too much. And when our economy can't produce enough goods and services to keep up with customer demand, that causes what? Inflation. The Fed met this month in February, and they decided to increase short-term interest rates by 25 basis points. And the reason they did that is because inflation right now is at 6.5%. And really, for a healthy economy, we really need to have inflation at around 2%. Now, the Fed is going to also be meeting in March, and they're going to meet again in May. And it's widely expected in both of those meetings, they're going to increase short-term interest rates by 25 basis points at each meeting, a total of 75 basis points this year. We also know that the January CPI report will be coming out on Tuesday, February 14th. Now, that January CPI report may influence the Fed to potentially do more increases, because that report will tell us if inflation is still coming down. We know over the last 3 months, inflation has come down. We also know in around July of 2022, inflation had hit its peak at around 9.1%. And in today's environment, we're at 6.5%. So it is starting to come down. There are also many reports out there that say food costs, gas costs, housing costs, and transportation costs are all coming down. So a lot of folks are asking, why then is the Fed continuing to increase short-term interest rates when inflation is coming down? A lot of the key drivers of inflation are coming down. Why are we still increasing rates? One simple reason. The Fed knows if they take their foot off of the interest rate pedal too fast, all the progress we've made on bringing inflation down over the last 6-7 months will be wiped out, because inflation could U-turn and go the other direction. And the reason the Fed is afraid of that is because our red hot labor market. You have to understand, guys, when people are making money, people don't have to worry about not having a job. They're more likely to go out and spend more because they're not afraid of losing their job. They know if they want to change jobs, they can, because of this red hot labor market. On February 3rd, the January labor report came out. See, it was expected that the U.S. economy would increase job openings by 187,000. Guess what we came in at? Over 500,000 new jobs added to the economy. And that's why the Fed is afraid. Because as long as we make money in this country and we have no fear of losing our jobs, guess what we do? We go out and spend, spend, spend. So that's why the Fed is still increasing short-term interest rates, because they need to get that labor market to cool off. Now, of course, they don't want to, have a mass layoff of people and unemployment goes to 10%. That's not what they're trying to accomplish. But what they are trying to accomplish is they don't want the economy adding 500,000 jobs. But inflation is still 6.5%. We can't sustain that. So we need a balance. And the only way they're going to get that balance is they're going to have to keep increasing short-term interest rates until people stop spending, until businesses stop hiring. Unemployment may have to go up a little bit. Right now it's at historic lows, 3.4%. It may need to go up to 4% or 4.5% in order to cool off that labor market, because that's the only way people are going to stop spending, guys. And if people don't stop spending, inflation is going to stay high. It's not going to come down. So that's where the Fed has that job of trying to balance risk. Do we keep interest rates high? Do we bring interest rates down? And it's a hard task, because right now, like I said, a lot of the leading indicators of inflation show that inflation's coming down. We know housing costs are coming down, like I said. We know transportation costs are coming down. We know gas has been coming down. We know even food costs have started coming down. But yet and still, inflation is still 6.5%. Why? Because our economy cannot produce enough goods and services to meet demand. People are spending so much, you just can't produce enough. So we have to slow down the spending. Once that spending slows down and we can get just the right amount of demand, just the right amount of supply, inflation will rapidly start coming down and we can get back to a healthy economy at around 2% inflation. That's what we need to do. But if that CPI report comes out tomorrow and shows that inflation is turned around and going back the other way, then I can tell you right now, when the Fed meets in March, there may be a 50 basis point hike. Who knows, right? We got to be prepared for that. Now, the market won't be prepared for it because, like I told you, the market only thinks a quarter in March, a quarter in May, and that's what they got priced in. So be prepared. If CPI comes out tomorrow and it shows inflation has did a U-turn and it's at 7.5%, you better believe the Fed will react to that in their March Fed meeting. So be ready. Stock market could sell off or it could just stay the same, depending upon what happens in the Fed meeting. Now, also tomorrow, when the CPI report comes out, be looking at the stock market. If it comes out where inflation is still coming down, market's going to be okay. If it shows inflation is going back up and we missed our target, then you may see a slight sell-off tomorrow in the stock market. But again, guys, we're long-term investors. So all we should be concerned with right now is buying assets while they're on sale and holding them long-term, because that's the way we're going to build our wealth, right? We're not going to be out here trying to day trade and do things like that where we have no expertise in. What we want to do is not be the expert. We want to buy ETFs that track the S&P 500 and the total stock market. And we want to buy those things consistently over time. And then we want to hold them 3, 4, 5 years. When this thing turns itself around, our economy is back at a healthy stage at 2% inflation. Stock market is going to start going back up again. We're going to be in the beginning stages of that new bull market. That's where you're going to start seeing the profits roll in from all of your investing that you do today. You will see a payoff tomorrow, but 3, 4, 5 years tomorrow. But if you do that, you put yourself in a big position, man, to win and win big when it comes to increasing your net worth. See, the whole idea is we want to buy these assets when they're low, when they're trading low. And then we want to sell them when they're trading high. And everything in between is our net worth gain, is our wealth. We may even want to hold those investments and start taking some income from them in the form of dividends. If we grow them big enough, right? That's the goal, is to create financial freedom. Our goal shouldn't be to just win short term. The goal is to win long term so that you can build enough assets to take care of yourself for the rest of your life and not have to worry about money. And you can go out and do the things that really are important to you. That's really what you want to accomplish. That's really what we're trying to get done. And us understanding where the Federal Reserve is when it comes to interest rates will help us with that. So we should know why the Fed is raising rates. And that's one of the reasons I like doing these videos. And again, guys, I'm no economist. I'm no expert. I'm just one guy giving you my opinion. But that helps me, knowing a little bit about what the Fed is doing, helps me as I invest in the reason why I'm investing, right? I know if we do not get inflation down, the stock market is going to stay down longer, because the higher short-term interest rates are, the lower the stock market will be. It won't bounce and go back to a bull market when we have 6.5% inflation and short-term interest rates are at 5%. It's not going to do it. We need to see interest rates come down, and then the stock market takes off. But interest rates won't come down. The Fed will not reduce interest rates unless we get inflation under control. So that's what you need to understand. The correlation between interest rates and the stock market. But right now, while interest rates are high, you should be buying paper assets, right? ETFs that track the S&P 500 and ETFs that track the total stock market. If you want those 12 free stocks from Webull, click on that link down in the description box, open up that new Webull account, go get that free stock, go get that free money. If you're stopping by the channel for the first time, please consider subscribing, share the video, smash the like button. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video. Peace. Today's video is sponsored by my company, RF Financial Consulting. And in my company, I work with individuals just like you through financial mentoring and coaching sessions. And in those 1-hour sessions, we talk about strategies to help you get to your financial freedom, whether it be through real estate investing, stock market investing, creating additional streams of income, credit card arbitrage, or starting and growing a business. If that's something that you might be interested in, there's an email address in the description box of the video. Send me an email and let's discuss if I'm the right fit for you.